A slowdown in economic activity characterized by the outbreak of the COVID-19 pandemic, as expected, left a huge dent in the National Social Security Fund's investments across the region.
Our investments, which are about 70% in the fixed income space, continued to take a knock in terms of our returns. The third area I would like to draw your attention to is the equity markets. The equity markets, the biggest indicator or index that we follow is the Uganda Stock Exchange, the Nairobi Stock Exchange, the Rwanda Stock Exchange, and the Tanzanian Dar es Salaam Stock Exchange Index. These indices all dropped significantly, specifically around the time when the pandemic was.
Consequently, for the first time in 10 years, the fund saw a drop in growth and contributions, but realized some growth in its income.
The second area of growth that we saw was in total revenue. Our total revenue increased by 17% from 1.25 trillion shillings in 2018-2019 to 1.47 trillion as at the end of June 2020. And the drive in this growth was mainly from interest income, and as a result of some of the high yielding fixed income investments that we had done, and our rental income.
This state of affairs, according to the fund's managing director, Richard Barugaba, could be bad news for savers, with high expectations of a beta rate compared to 11% declared in the financial year 2018 and 19.
It's unlikely that we will be able to pay members a double-digit interest rate. To contextualize this situation, the fund last paid a single-digit rate 9 years ago in 2010-2011.
The fund paid out 486 billion shillings in benefits compared to 450 billion shillings paid out in the financial year 2018 and 2019. Some 66 billion Uganda shillings was not collected due to the deferment policy. According to today's figures, the fund's assets under management stand at 13.38 trillion shillings in 2020 compared to 11.3 trillion shillings in 2019.